All right, guys, what's up? Alec back with another stock market investing video. Today, we're here to talk about 3 stocks to be watching right now, and we're going to go a little bit more in a deep dive into these ones and look at their balance sheets, their income statements, their financials of this one to see which ones and see if it's a right fit for you too. Now, first off, we've had a great week. I'm up 11% just in the last week. And one thing I want to touch real quick before we get into the video is, in the last 3 months, if you pull the last 3 months, look at this roller coaster on a ride that we've been through right now. We started up 20% up to 10K. Then we went all the way down to -1, all the way to 8K. And then we had a run up all the way 16% up, all the way to 10K almost again. And then we saw a small fall all the way down to almost 8K. Then we saw it run up to 23%. And then this was the most recent crash that we saw here. And now we're back up again. So, stocks is not just a straight line, 16% up, 17% straight line up. It's going to look more like a roller coaster when you're holding and not trying to just sell into your position, sell out of them. Holding long-term does win in most cases. So with that being said, the first stock on my list is going to be Intel, ticker symbol INTC. And this one shouts out to me because if you look at its previous supports, it's never gone lower than about $43. And that was almost like 3 years ago in 2017. So it's never broke the support of $43. And I don't think it will at this time also. Intel, it's one of the biggest PC and computer manufacturers. So the first thing we looked at this graph, the graph looks good. Then you look at stats, and the stats on the looks good too. The market cap is 187 billion, which is a good sign. We like anything over about 2 to 5 billion, somewhere in that range or higher. The PE ratio is 8 on this one, which is excellent. That's right where we want it. Anything below 15 or 20 is typically where we want it. In this market, it's a little bit overbought, so it's hard to find companies with a PE ratio of 8. So that stands out as a really good sign. And it also is a dividend stock. Look at that. It's 2.9% dividend on it. So you can read some of these news articles too. And one of them says why the best outcome for Intel shareholders is to break up the chip maker. You can read what the bulls say. Intel is one of the largest semiconductor companies in the world. Intel has made a string of savvy acquisitions to build its AI and automotive offerings. And you can kind of go through that, read what the bears say on your own time too. But you can kind of see, look at their earnings are all the way bottomed out too. So Q3, even Q2 and Q1, when the pandemic was at an all-time high, it still wasn't as bad as Q3 when they reported that. So let's dive into their financials. So here we have their total revenue pulled up. And in 2015, you can see they were at 55 billion. 2016, they only grew by 7%, which is a small amount. 2017, they only grew by 5%, another small amount. 2018, they grew by about 12%. And they're at about 71 billion in 2019. Now, typically our rule of thumb is we like to see companies growing by double digits consistently every year, at least 10% or more. And it looks like their total revenue as of right now is 78 billion, which is a good sign to see too. Now, if you pull up their net income, that's where they shine a little bit higher. You see in 2016, they were at about 10 billion, and then they went up to 15 billion in total income, and that raised them by 45%, which is a great double digit that we like to see. And then in 2018, they grew again by 38%, all the way to 20 billion. So if we scroll down to their balance sheet, we'll see their assets versus their liabilities. And they're pretty good on their assets versus liabilities. They're about 2.5 times more assets than liabilities, which is a pretty good number for a big company like this. It's hard to find 5 times, 6 times the amount of assets to liabilities. So they're doing pretty okay with that. And then this page at the bottom I really like too because it's peer comparison. And it's 102 companies in semiconductors, and you can see their EPS is one of the best. Their PE ratio is number 1 in all semiconductors, which means they're one of the most undervalued companies in semiconductors right now. Their assets to debt to assets isn't the best. It's about middle of the road. Their dividend yield's one of the highest dividend yields in semiconductors, which is a good thing to look at too. And stock number 2 is going to be Dropbox, ticker symbol DBX. This is one I think can go for a long distance, and it's going to go the long distance. A year, 2 years from now, you're going to be wishing you picked up this stock. Just like Upwork, I was talking about a few months ago, it's up about 100% now. And I think Dropbox is one of those stocks that can actually go up just like Upwork did. Now, you'll see they just reported earnings, and they absolutely smashed their earnings too. So here you'll see in Q3 of 2020, their earnings were way higher than they've ever been. They actually almost did about a 60% increase of what the analysts expected on their earnings this season. And they were up about 8% in the day, but now they're down 5% after reporting a smashing earnings. So a lot of companies reported really good earnings, like Peloton's another example, and they fell after hours. So that can be a sign that we're going to see a red tomorrow and a red rest of the week. But we'll just have to stay tuned and see what's going on, because the stock market is very unpredictable right now. So we got a market cap of $8 billion, which is right where we wanted. The PE ratio is a little bit high on this one. And when you're looking at a growth company like this, PE ratio isn't always going to be the best thing to look at. That's more of trying to find like a value company and a value investing. This one's going to be more of growth investing. So when you're talking about growth investing, what you really want to see is total revenues growing double digits consistently every year. And when we pull up Dropbox's revenue, you can clearly see in 2015, they only had $6 million in revenue. Then they grew that 40% to $844 million. And then in 2017, they grew another 31% to $1 billion. And then in 2018, they grew another 25% to all the way to $1.3 billion. 2019, they grew 19% to $1.6 billion. So this is really, really important when you're looking at a growth company, something that you want to see exponentially growing in their revenues. Now, if we scroll down to their balance sheet, you'll also see that they don't have the best balance sheet. Their total assets to their total liabilities, they almost were matching up at one point, 2015, 16, and 17. They basically had equal assets as liabilities. But we see steps in the right direction in 2019. They have significantly more assets than the liabilities. When looking at a growth company, balance sheet's not the most important thing to look at. It's going to be total revenue. But when you're looking at value investing and you're looking for a safe company, that's going to be value investing. Growth is a little bit more risky with growth investing. Now, if we look at Dropbox, what analysts have to say about them, I like to always look at the sales growth year estimate. They actually have Dropbox growing anywhere from 14%, 10%, just next quarter, current year 14% too. So the good thing about Dropbox is their big growth days aren't behind them. We're actually right at the beginning. I think we're going to see a lot more growth coming in with Dropbox coming up soon, because they have a lot of big plans that I can make a full video about when they're getting in the HR space and the online space. It's going to be a game changer with Dropbox. And then the last one we're going to talk about today is going to be Slack, ticker symbol WORK. This is a great company. I recommend you guys looking into this and kind of seeing their business model. We can make a whole video about this one too, so comment below if you guys want a whole video on work or a whole video on Dropbox. You can kind of see I'm already up 7% on them, no big deal. Their market cap is $15 billion, which is a great sign that we like to see. And you can kind of read what the bulls say. The Slack user base, its company's revenue and growth is rapidly growing, which we'll get into, and expected to continue to do so over the next few years. So again, this is a really big growth company. Just like Dropbox, this one could also be the next Upwork that can gain 50, 100%, some crazy amounts, because they are crazy growth beasts. Now, their expected earnings are on 12/3, so about a month from now, we'll see them beating earnings. They've consistently beat earnings, and they will do so again. So if we pull up the total revenue on ticker symbol WORK, Slack, you'll actually see their total revenue, just like Dropbox, is absolutely explosive. And this one's a little bit more explosive we're getting in at right at the beginning. So if you can get in at this one about $25 and start buying even right now, I think it's at $27 a share right now. You can start buying slowly, but buy most of it around $25, $24. You'll be ahead of the game. So you'll see in 2017, they had 100 million a year in revenue. Then they grew 109% in revenue to 220 million. And then they grew 81% again, which is these are triple digit numbers almost, to 400 million. And then they went to 600 million all in 2020, which is about 57% gain, which is absolutely ridiculous. And I think we can continue to see work growing at about 20-30% a year, maybe even 50-60% a year consistently for the next 2-3 years, and even more, even 5 years too. So they're a company I'm really excited about. If you pull up their balance sheet, it looks excellent too. So what you'll see here is in 2017, they had like 4 to 5 times as much assets as liabilities. Same thing in 2018, 2019, same thing. They had about 4 times as much assets as liabilities. And then in 2020, they increased their liabilities a little bit. So now they're at about 2 times, assets to liabilities, which is a little bit more towards not my liking. But they're a growth company, remember? So the balance sheet isn't as important as the total revenue. But it's always good when a growth company with crazy revenue like this, increases in revenue, is having a great balance sheet like that. It really ties it together and shows that it's a company worth. So if you pull up the same thing for work, ticker symbol WORK, you'll actually see the sales growth is going to be 30%. So Dropbox, it wasn't as big, it was like 10%. So this one's an absolutely growth beast. I'm excited for 39% analysts have them at. I have them about 40%, anywhere from 30 to 40 to 60%. I can see them growing year over year. So I hope you guys did like that quick video. I just wanted to go over those 3 stocks, dive into them a little bit, let you know what's going on in the market right now. And if you need help actually going ahead and getting your profile to look a little bit more like mine, 16% in the last 3 months, go ahead and reach out to me on Instagram in the direct messages. I'm taking a few more clients on right now. I also have a close friends list if you guys want to see buy signals, price alerts, and everything too. Leave a comment on the video of what you want to see next, so I can actually make more videos for you guys, and hit a thumbs up if you really did enjoy the video. Don't forget to also share with your friends if you did like the video, and maybe you guys are thinking about these stocks as well. If work was on your mind, if your friends are talking about work or a Dropbox or any of the other stocks we talked about today, go ahead and share the video. Hit the like, it takes 1 second to like, and it really does go a long way when you guys like the video. I put a lot of time into these too. So that being said, remember, don't time the market, buy the market. Peace.